This voice is taken from an article with the title, "What is the Impact of Economic Indicators on Currency Volatility?" which has been published on TraderTalks.net. The economic indicators of a country are a set of data that provide insight into the current and future economic health of that country. These indicators are used by investors, traders, and analysts to determine the direction of the currency market. In particular, the economic indicators of a country are important for monitoring the currency movements in the global forex market. The economic indicators of a country determine the direction of the currency market as they provide information about the current and future economic health of the country. For example, the gross domestic product, GDP, represents the total value of goods and services produced in a country and is a major indicator of the overall economic health. A country's GDP is a major factor in determining the strength of a currency. When the GDP of a country increases, it is usually accompanied by a strengthening of the currency. On the other hand, if a country's GDP decreases, the currency will likely weaken. In addition to the GDP, other economic indicators such as inflation, interest rates, unemployment, and manufacturing activity can also have an impact on currency volatility. Inflation is the rate at which prices for goods and services increase. When inflation is high, it can cause a currency to weaken. On the other hand, when inflation is low, it can result in a currency strengthening. Interest rates are another important economic indicator, as they can cause a currency to either appreciate or depreciate. A country's monetary policy and central bank can have an effect on the interest rates, which can in turn have an effect on the currency. Unemployment is another important economic indicator. When unemployment is high, it can have an adverse effect on a country's economy, as well as on the currency. Similarly, when the unemployment rate is low, it can result in a strengthening of the currency. Lastly, manufacturing activity is an important economic indicator, as it reflects the level of economic activity in a country. When manufacturing activity is high, it can lead to a strengthening of the currency. In conclusion, economic indicators have a significant impact on currency volatility. These indicators provide insight into the overall economic health of a country, which can help investors and traders make better decisions when trading currency pairs. A country's GDP, inflation rate, interest rates, unemployment rate, and manufacturing activity all have an effect on currency volatility. It is important for investors and traders to monitor these economic indicators in order to make informed decisions about their trading strategies.